Good evening. Welcome to the ShadowTrader Video Weekly for Sunday, June 19th, 2016. Happy Father's Day to all the fathers out there. We are stuck in the middle of a trading range, which, contrary to what I told you last week, I am starting to think resolves lower. And I'll show you some key reasons as to why I think that. And the main reason is because of the action on Thursday being so very clearly short covering, and the fact that Friday really wasn't able to build on that action at all, especially since it was an options expiry day, which is usually somewhat bullish. But regardless, we're going to kick off here with this larger chart here, the SPX, and you can see the larger fib retracement is here of this entire move, of the bigger move from the February low, and then I have embedded another Fibonacci retracement here, right into this this smaller move here. And you can see that right now, as I was saying at the start of the video, we're kind of stuck basically in the middle of a trading range, because this area is a trading range, and of course we are kind of hanging out right here. And a good amount of the action in the past week, 4 days of it at least, going back to Tuesday, was in between the 50 and the 61.8 retracement area. So that's basically anyone's guess. But as I was saying earlier, I feel that the resolvement here could be to the downside. And again, I totally understand that that's contrary to what I said last week. But of course, these videos are recorded only once a week, and a lot has happened. You can see the market has actually come down, quite a bit. We hadn't come down as much last week at the time, and being that prior to last week's video we stopped just 15 handles shy of the all-time high in the SPX, my thought was at the time that, well, it just doesn't make sense that we would come that close and not revisit it. But like I said, my tune may have changed a little bit here. Jim Dalton, who is my mentor in the market profile, somebody whom I have immense respect for, as you know, I tend to speak very highly of Mr. Dalton. He has said one thing that has always stuck with me. Obviously, a million things that have stuck with me, but one thing that's very applicable to what we're discussing right here and now. And he says that if any market can fall out of bed without making an excess high, the S&P is the one. That in his experience, he's always seen that in all the different futures that he's charted and put the profile on, it's the S&P that is the most susceptible to basically falling out of bed without having a proper excess high. And just from my experience of just the last few years specifically, as I've been following the profile, I've noticed that he's dead right. The S&Ps basically do that all the time. They just fall out of bed without warning. Whereas if you look at crude or gold or other things that can be charted with profile, it's not the same. They generally will have cleaner moves that have the excess top, the blow off top. You get a shadow on the candle, and there's an excess high on the profile, et cetera, et cetera. So that could easily be the case here. It could easily be the case that the S&Ps are looking to fall apart here, but after coming 15 handles from the all-time high. Perhaps that was it. It could be a double top, but it doesn't really matter as much to me, and it shouldn't matter as much to you. I understand that there's a lot of people who watch these videos who are longer-term traders, possibly like core type investors that may be watching just to get an idea of where I think the market's going to go in the long term. But you have to understand that it's not that it's not my bailiwick. It's not really the arena that I play in. I guess that's the same thing, I suppose, but it's not where I make my money. So I don't need to really know, basically, is what I'm saying. Like if this was the top and we're not going any higher, that's fine with me, because I'm not the type of individual who's holding some large portfolio of equities with a time horizon of forever. And honestly, that really is the time horizon of most buy and hold investors. You never hear the word sell from them. You never ever hear, well, Amazon broke 700 today. I sold my shares. It was great. I think we picked them up for 300, 10 years ago. You never ever hear that. It's just hold through all the rallies and hold through all the pullbacks or whatever. And this isn't an indictment of that style or whatever. I'm just saying that I don't do that. My forte is to extract amounts of money on a regular basis in shorter time frames. So that being said, whether that was the top with the 15 handles or not in the bigger picture doesn't really matter. There's always something that can be done in order to structure, options and stocks for the next 5, 7 to 15 days, maybe maximum, to make some money. So we'll see. So given that, because this shorter time frame is the one that I'm interested in, I really just want to know what's going to happen by the end of next week. Again, I think that the downward momentum that we've suffered here could actually turn into more, which would take the market to 2025. And in order to sort of put some weight behind that argument and make it so it's not just my opinion, I have to turn to the profile. So let me just pull this over here. Okay, so here's our profile. And I'm going to turn on the overnights for the whole week. And basically, what I want to focus on here is this big Thursday here, because it was so bullish off of the lows. The market just kind of turned around like out of nowhere. And it's not really out of nowhere because, remember, you've got this. See this? This was a virgin point of control that was never tested. And you see this? This was a gap that was never filled. So it's no real secret as to, you have to, if you don't see it while it's happening, you can pretty much always go back and say, okay, why did that happen and where? And this is what the futures market does. It needed to test this point of control and fill this little gap, and that's what it did. And in doing so, the market turned around hard and had a lot of short covering. And that's what I want to focus on in this video, is the fact that it feels to me, when looking at the evidence here, that the rally on Thursday was nothing but short covering, and we probably see a little bit more downside. So why did the market turn so hard from midday Thursday? Well, the reason I believe is because the market was down hard without a pause. Here you had a little bit of pause in selling, but you still had all this short position accumulating. And even here, on this particular day, even though the market rallied a bit and made a new 2-day high here, right, the difference between these two highs, it closed low. So you still continued to have lower close, lower close, lower close. So the market's getting shorter and shorter. And then on top of that, you have here Thursday overnight, Thursday morning. Look at the overnight session. The overnight inventory is almost 100% net short. Almost, right? Because you measure it as to what percentage of the overnight inventory is above the settlement or below the settlement. So look, this part here, there's the line. All of this here is below the settlement, and all of this is above the settlement, right? So you have the majority of it being net short. So what I like to think about when I see a situation like that is I kind of think of it as that they're just piling on. It's just too much. And so they pile on short, and you can see here, the market opens down here, close to the overnight low, takes out the overnight low, keeps going lower, and now the market is really short. And that's why it turns around and rallies so hard, because all it is just too short. It's not that there's a whole bunch of buyers down here who look for things like gap fills and say, oh, wow, this is value down here. This is a great price to buy. I don't think so. I don't really see it that way. And in rallying all the way back, and even though it went down early, it traveled through all different levels here. Notice that the profile is very thin and very stretched out. So that's a typical example of a market that's a lot of short covering, when the profile is very, very thin and stretchy like that. And it closes at the high, and then Friday morning we have a very balanced overnight session, and then the market sells off some more. And I thought it was interesting that it was options expiry. Usually the market will close flat to higher and actually close down a little bit and retraced a good amount of this and traded lower than halfway back. This is the halfway point right in here of Friday's range. Market actually traded lower, but it did not close there. So coming into next week, what I'm going to be looking at is basically this area, which is the halfway point of that Thursday range, and see if any value develops lower. If some value develops here, the market is definitely going lower. If we have a hard reversal to the upside, which I would have thought that should have already happened Friday, and that's another reason why I believe that the move will probably be down here. I don't believe that everybody in this day finished covering their shorts. probably there's probably should have been more short covering after this, is what I'm trying to say. There should have been more short covering because you closed at the high, everybody's short into here, you have all this shock and awe, cover, 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 and then what happens on Friday, we actually gap down a bit and we sell off, we start to liquidate, and we build value somewhere in here. So again, so that's basically my argument as to why I think it could be a bit down. And all that being said, it is still against the backdrop of an S&P that's really stuck in the middle of the range. You've probably heard me use the phrase, which I overuse, I will admit, this is a hard pattern to get lower out of. It's not that maybe that I overuse it, it's that the market continually gets itself caught in that type of pattern. This is also a hard pattern to get lower out of because you have to retrace 100% of this move here, and so far you've done about 61.8% of it, a little bit lower at the lows. So you've got to really kind of power through here. It's a lot for the market to kind of chew through. But obviously, if that Thursday low gets taken out, then it's easy sailing to the 2025, and that's pretty much where the market's going to go because that is, of course, a strong support point from before. Remember, this is what's called major support and minor support. A major support is the support that comes into play before a new high is made, and it doesn't have to be an all-time high. The way I like to read it is it just has to be higher than the last high. So I often refer to that as a swing high, and you have to be careful with that term because a lot of people will just call it a swing high or a swing low if it's bookended by a higher low or a lower high. Like for instance, here in the circle, this is a swing low. And that's true, but to me, there's two definitions of it. I use that swing term loosely to denote a high within the context of a larger chart. So to me, I call this a swing high because it's just this basic move is a swing move, and it's the high of this move, which is higher than this move. So I just want to clarify that so I don't confuse people. So that's the S&Ps right there. All the other majors are looking the same except for the NDX, which I think is confirming what I'm saying about the weakness, because notice that the action of the one bullish day took prices above the trend line just by a little, and Friday's close on the NASDAQ 100 was actually lower than the 61.8 retracement, whereas the other majors bounced, correct? So it's below, and it's closed below the 61.8. So it's probably easier for the NDX to continue down and come to its support point, which matches up with the 2025, excuse me, in the SPX. All right. Let me leave you real quick. I've already talked for about 13 minutes here. I like to keep these videos around 10 minutes because I think they're just easy to digest in that time frame, given that the general attention span of people is just a couple of minutes nowadays. Let me leave you with some ideas. I have a short list of stocks that if the market does come in a bit, I'm going to be looking for some buys. And I don't mind sharing them all with you. Avgo is the first one. This is Broadcom Limited. You can see where I have my alerts set. Look at the support here of the trend line coming in around 150. That's one. AYI, Acuity Brands. I like this a lot. I believe this is going to be the free trade idea of the week by our man in the field, Dano, who puts out the Swing Trader newsletter, and he handles all that. He's going to be, you'll see in the weekend update, the free trade idea of the week. If you scroll down in the email that you got, it's going to be AYI. He'll give you a little update on that. Basically, it's just a simple play in that I don't think that the gap fills right away. I think there'll be a bounce here. And obviously, this is all commensurate with what's going on in the broad market. If I can just digress for a second, if you remember, I don't remember the exact stocks, but for instance, Mass was one that I gave you last week. And a couple of people emailed me and say, oh, did you buy Masco? I know you liked that in the video. Well, I did not, because I actually put an order right here for 100 shares right in this area. That's how I usually do it. So I do place alerts, but usually I'll put out orders for like 100 shares and let it get filled, because it psychologically just gets me in the game. It's like, okay, money's on the line. I got to pay attention. As opposed to when you have, say, 20 alerts go off over a course of a day. oftentimes you don't ascribe much weight to it, or you may be involved in another trade and you're just like, yeah, whatever, and then the opportunity goes by. So that's something to think of also. I always warn people against setting too many alerts and having alerts just go off constantly, because the more things there are, just in general in life, whatever, it doesn't matter what the things are, the less weight each one has to have. That's just how it is. Like, I find it very interesting when I hear about people who have 175 positions in their portfolio. It's like, what do you really care about each one? And then if you don't care about each one, all those little ones that you don't really care about, little by little, it all adds up to a bunch of losses. So, or a loss that's pretty big, and you're also just kind of indexing yourself to the market really at that point. So I don't really understand that. I think that even longer term investors should have, 8 to 10 good stocks, things that they really believe in, that they really care about, and watch those things closely. But regardless, Masco is a perfect example, where last week in the video I told you that I liked Masco at this support level, and my 100 shares went off. I was long Masco, and it went 20 or 30 cents against me, and I saw what the broad market was doing, that the broad market was falling a little bit harder than I was comfortable with holding stocks long, and I bailed and lost $30. That's basically it. So, sometimes that's the best way to go. It's not that I'm starting with a starter position or anything. It's that I put the order in to make me kind of, get into it. But if the market's not cooperating, then I'm not buying the other 1,900 shares or 2,900 or, whatever I thought the position would be in shares. I'm not buying the rest, so that's that. So basically what all this means is, all of this is commensurate with what the market's doing. If the market's crashing, I don't like any of these ideas. If we're holding up okay, if we come to the 2025 and it looks like we're going to have some support there and things are looking rosy, then I do like these. All right, CRL is another one. Charles River Laboratories has some trendline support here. And I know I just got finished talking about a whole bunch of alerts. Yes, I have alerts set, but when the alerts get set, if I still when the alert dings, so I know that I'm close, then what I will do is I'll put my order in for the small lot right here where I actually want to get filled. So the alert is just kind of the first heads up. CRL in that 79 area, CTXS, Citrix Systems. This one is interesting because I think that if I'm wrong about the market and the market's going up next week, then I think the stock goes up right away because it's already at trendline support. So CTXS is one that might be in play early. And Facebook is here at the 108 area. I know that the folks at Citron Research said they don't like the stock anymore, but whatever. It's a pretty strong name, and this support area should be interesting. And last but not least, one called USCR, which is Uniform Sierra Charlie Romeo. And that one is kind of similar to CTXS in that this strikes me as just a lot of H patterns over and over. And so you can see here, look, boom, letter H, right? Over, letter H. And right in here, it's already at support. And you can see that it's having difficulty getting through. So in a bullish tape, I think you get zoop, and you at least go up here to the midpoint. You can kind of run that stock from like 59 to 62 or so. All right? And that's all I've got for you. Next week is going to be very, very interesting because we have the Brexit vote. Who knows if they're even going to vote. Unfortunately, there was that tragedy where that woman from Parliament was murdered outdoors. That's extremely sad. And, so they've put the campaigning on hold a bit for a couple of days as of now. We'll see if they actually have the vote. If they do actually have the vote, that's June 23rd. And it should shake the markets up a little bit, so we'll see. All right. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, as always, I wish you good trading and good night.